At the macro level, I think that we're playing a very dangerous game of chicken with the Fed. 3 or 4 months ago, we only thought that there was going to be a handful of interest rate increases. And increasingly what has happened, the market has remained so resilient that the Fed has sort of put out more and more data as the data has justified them being a lot more aggressive. And it kind of crescendoed this past week where they basically said, listen, we're going to move by 50 basis point increments for the foreseeable 2 or 3 rate hikes, and we're going to start quantitative tightening. What does that mean? That means that instead of basically printing money and coming in and buying securities from the market, right? So what happens? When they enter the market with money that they literally do print and buy your bonds, they're giving you cash in return. And typically what that has led to is the inflation of all assets, right? Equity assets have gone up, bond assets have gone up because there's just nothing else to buy. When quantitative tightening happens, they reverse that. And what they're going to do is about $95 billion a month of the opposite action, which means they're taking money out of the system, right? Or in this case, what they're going to do is they're going to let a bunch of maturities roll off and not renew them. Okay, so why is this important? Well, it's important because, we're still 4% from the highs. So we have 7% inflation. We have all this crazy stuff happening. We have a war, going on. We have massive price issues. We have supply demand issues, and the market keeps shaking it off. So I think what the Fed's going to do is get even more aggressive. So you're going to probably see, a lot of 50s, maybe even a 75 point hike. You probably are going to see them, even ratchet up quantitative tightening until there is a bit of a bloodletting in the equity market. They need to see that the market's cracked.
And so they literally need to see what percentage drawdown or just to go sideways. What do they need to see in order to, or is it inflation coming down a couple of points?
Well, the problem that we suffer from is that they're going to look at the highest level indexes, right? They're not looking at single stocks. And so when when you and I think this market is down 4%, we don't feel that because some of our companies are down 50 and 60%, right? But that's because we're all focused on high tech growth. But they look at the broad indices, and the broad indices have held up really well. And mostly it's because, if you look inside the S&P 500, 40% of every dollar is, Apple, Amazon, Microsoft, et cetera, Tesla. So we're in a situation where I think until the Fed see that there's a massive trading of liquidity, which means you see these indices crack big time, 3,600 in the S&P, they're just going to keep ratcheting things up. As it comes all the way down to our companies in Silicon Valley and tech, what that means is you have to start planning for the worst. And I think the worst means that there's an 18-month period where you cannot raise money on your terms. You have to raise money on the market terms. And so if you're not in a position to show good growth over these next 2 years, I would encourage you to just get your balance sheet in order to wait it out.
Sachs, nuclear winter is a possibility here. Markets for startups raising money, again, as Chamath's saying, could be on the terms of the capital allocators. What's your advice to founders? What are you seeing in the boardrooms that you're on the board of? And if you were running one of these high growth companies for the past year, what are the first 2 or 3 things you do?
The first thing you got to do is look at your burn multiple. How much are you burning relative to how much incremental ARR are you generating? You look at Fast, they raised 120 million, a year ago. They're out of money now, so they burnt 10 million a month, like you said. Here's the crazy thing. If they had just slammed on the brakes 3 or 4 months ago, when we were talking on this pod about the coming downturn, they could still have $30 million in the bank. That's a lot of money. The only reason it doesn't seem like a lot of money is because they've been burning 100 million over the past year. But objectively, $30 million is a gross Series B, which is actually a lot of money for a company that only has 100,000 in revenue. So they could have saved that company if they had slammed on the brakes 3 months ago and rationalized the cost structure, and they didn't. So they hit the wall at 100 miles an hour.
Who's responsible when something like that happens, David? Because we've all seen it. What is the suspension of disbelief that creates this kind of stupidity?
That's what it is. You've got people who are kind of drinking the Kool-Aid, and there's nobody advising them to stop, or if there is, they're not listening. Look, PayPal had this situation back in 2000, the year 2000, right after the dot-com crash. We were burning $10 million a month, like Fast. We had no revenue and no business model. Okay, and we had said the service would be always free. we had 4 months basically of life, and we pulled up on the throttle. And what we did is we basically introduced paid accounts. We started charging transaction fees, and we cut the cost structure of the company, and we made that last $40 million last a lot longer than 4 months. It lasted until we could then do another fundraise the following year. And we were able to then raise with good numbers, real revenue, a business model, et cetera. So, and that was because we were just paying attention to the changing environment. The world had changed from sort of the pre-dot-com crash, 1999. Your business model didn't matter. Your margins didn't matter. Revenue didn't matter. None of that stuff mattered. All that mattered was growth. But by, mid-2000, everything had changed. So you have to be attuned to what the fundraising environment is looking like. And if you're a high burn company right now that's not generating a lot of revenue to go along with it, you better slam on the brakes and rationalize your cost structure before it's too late.
David, tell me, what do you think is going on in this board meeting? I mean, this is a group of incompetence.
I don't even know who's on the board because Stripe led 2 rounds. I think the reason why a strategic investor invests is because it's strategic for them. I mean, it was in Stripe's interest to try and back a winner in the whole e-commerce checkout line sort of payment space. And so they did that. And I don't even know if they had a board seat. And so no one was really.
But I don't understand that strategic decision because I suspect the rationale somewhere internally in Stripe, which is pretty flawed, is, hey, we can't do it ourselves because if we did, we would be competing with our customers. But picking a winner and putting $120 million is tantamount to the same thing. So I don't understand.
I mean,
it doesn't make any sense.
Right. And Stripe raised money at a, $9,500 billion valuation. So look, it all flows down from, the frothiness at the peak.
No, I'm saying I think it would have been much more credible for Stripe to say this is a critical piece of the infrastructure and value chain in payments that we want to own. So we're just going to go and put some of our better engineers as like a, side project and see if we can tack away at something that works. I mean, I think a lot of people would have adopted it. I think this time around, it's probably important for employees to understand a couple things. One is who doesn't know what they're doing, right? So companies that are making layoffs, those are happening. They shouldn't get punished for that. But you got to think the fiduciaries that are ripping this money in. I mean, do you really want to be the person that goes to work at a company that's backed by these folks in round 2? I mean, that's not a signal. Like the opposite has always been a signal, right? Meaning when Mike Moritz makes an investment, we all pay attention because we all think, wow, there's a picker, And he did that with Stripe and with so many other, great companies. And so the likelihood of an employee wanting to work for a Mike Moritz-backed company or a Mike Moritz governed company is very high, right? Same thing with Gurley's, same thing with a lot of really, really good investors, John Doerr. But the opposite should also be true then, because if you really want to work for a Peter Thiel-backed company, you should probably not work for one of these companies where these folks who are just completely absent are also governing the board. Because that just means nobody knows what's going on.